Eduardo Saverin was a Harvard bachelor. He wasn't your typical A student, however, he was an extrovert with the talent to connect with people, so his roommate offered him to join his startup by investing $15,000 and becoming his business partner. Eduardo didn't hesitate and immediately jumped on board. However, the two friends couldn't go along, and Eduardo was kicked out of the company. But it wasn't all bad news. As the company went on to become thriving, which is today known as Facebook, his $15,000 investment turned into over $10 billion. Sometimes it's just about being in the right place, with the right people, and having the courage to take some risks. However, that's not always the case. In January of 2021, when hedge funds miscalculated their moves and bet against GameStop, thousands of retail investors jumped in to grasp the opportunity but were left with their savings evaporated, as the stock crumpled and retail investors lost everything. Looking at these two examples, it seems like investing is more like gambling. If you are lucky, you will make millions, maybe even billions. If you are not, then you are destined to fail. However, Peter Lynch has proved the absolute opposite. Over the 13 years he has managed Fidelity Investments, his average return was 29.2%. That's more than double the S&P 500 index, which represents the 500 largest U.S. companies. He turned $18 million to over $14 billion in just 13 years and became the most successful investor in history. But how did he do that? What are his investment strategies? Can anyone follow this strategy and turn thousands into millions and millions into billions? We will answer all of these questions and many more. Hello viewers. Stephen here and I welcome you to this channel where we talk about investing, business, and finance. If you are new here, welcome, and why not hit that subscribe button and join our community. And as always guys, give this video a thumbs up for that YouTube algorithm. Now, let's get into it. Looking at all these graphs, investing seems complicated. When you want to invest, you must analyze financial statements, read reports, understand strategies, and make an intelligent investing decision. However, investing is often much easier than many people presume. In fact, hedge funds often make it difficult to push rich people to invest with hedge funds since hedge funds charge an extremely high commission even though they barely beat the market. In fact, you can have a much deeper knowledge of a company than hedge funds. Hedge funds often look at a wide range of companies, analyze multiple stocks, and often invest in companies that are proven to be good investments. But you, on the other hand, can concentrate on a few companies whose products you use. Wall Street will only try the products of some of the companies they invest in before throwing millions into it. If it's a local startup that began in your city, you have the upper hand to test its products and find out the potential of the company before it goes mainstream for Wall Street to pay attention to it. The moment you see that the company has hit the news, then Wall Street is definitely watching carefully. So your only advantage to competing with companies that have thousands of professional analysts working for them is to spot companies that have yet to become mainstream. But how do you discover such companies? It might sound impossible, but it's real and practical. You may be interested in something. Be it cars, tech, social media, artificial intelligence, coding, design, games, or whatever. You are probably working in that industry or following the news out of curiosity. You know a lot more about what's happening in that industry than most Wall Street analysts. If you are a designer or an editor, you are constantly trying new tools or software, so you are more likely to come across a company that will go mainstream than these multi-billion-dollar hedge funds. Tesla is a great example. Back in 2010, when no one was talking about EVs, Tesla had already launched the Roadster. Then in 2012, it launched the Model S. But its market cap was just a few $1 billion, and the stock price was trading at about $2. It took Wall Street years to admit that EVs are on the way to replacing traditional cars. But anyone who is into cars, especially electric ones, clearly knows that the future is electric, and Tesla appears as one of the companies that will dominate this industry. Fast forward to 2023, the company is worth over $600 billion and even crossed the $1 trillion valuation in 2021. Early traditional retail investors earned fortunes. You are not going to find such companies by reading Bloomberg or Yahoo Finance. You are going to discover them by being an expert in one field. Your job should be to find companies that will increase at least tenfolds. That sounds overly optimistic, but it's possible. You shouldn't be investing in companies that are trending in the news and that is oversaturated. If you are spending hundreds of hours analyzing their financial statements, reading their quarterly reports, and finding out their strategies, then it better be a company that has the potential to grow that big. If it's already there, like Tesla or Facebook today, then it's a waste of time since investors have already ripped off the rewards. So when you find undervalued companies that are still too small for Wall Street to notice, you jump in. But you have to keep in mind that investing is inherently risky. If you embrace this fact, you are not going to be impacted by the ups and downs of the stock market. The daily news often influences the market. Any bad news will pull down the stock price. So you shouldn't be investing any money that you need in the next 6 to 12 months. The mistake that people often make when they start investing is they focus on the market and not the company. Mr. Market, as Peter Lynch calls it, has a different mood every single day. Bad news will push it to plummet, while good news will dramatically raise stock prices. But the underlying value of companies stays the same. Companies that have strong financials and a solid growth strategy often outperform the market over the long run. So forget the market, focus on the company. Look for companies that sound boring since they won't be attracting the unnecessary attention that would push them to be overvalued, like a waste management company. The business doesn't revolutionize the world, but such a business with a solid foundation can grow exponentially. When looking at what company to invest in, always try to find what makes this particular company better than its competitors. What is their competitive advantage? What do they have that their competitors don't or will take years to get? Their technology may be superior, they may be much more cost-effective. Maybe their product is better. Doesn't matter. When a company has an advantage over its competitors, that's when you know that they can grow tenfolds at least. When you look at the stock market, there are different types of stocks. Some stocks pay dividends, others don't pay anything. At first glance, one sounds better than the other. However, the facts on the ground tell a different story. A dividend-paying company might have reached its peak and has little room to grow, while the non-paying dividend company believes that investing that money back into the company will be a better investment than paying it to the investor since the company will grow much faster. The only way to really profit from the market is to focus on growth stocks, on stocks that don't necessarily pay dividends but has the potential to grow exponentially. Before you start investing, write down all the reasons why you think you should invest in this company. That way, you can analyze your decision once you have thrown your money in. If you have ticked all the boxes and your analysis was correct, keep it up. If not, then there is room to improve. Thanks for your time, until next.